XRP family. They want you to leave, nevertheless. Perhaps one of the most carefully planned crashes in the history of cryptocurrency was what we just saw. I don't say that lightly, either. Since 2018, I have been involved in this market. I have witnessed coordinated leaks, manipulation, and even flash crashes brought on by panic. However, nothing like this. It wasn't pandemonium that just occurred. The timing was right. Planning was involved. It was a surgical procedure. They struck the market at the precise moment when liquidity was limited, when merchants were at ease and everyone believed that the worst was over. The floor then abruptly disappeared. XRP was destroyed, not simply dipped. We were able to maintain that $310 level for weeks at a time before it crashed below 125 on Binance. In little than an hour, that is a 53% fall. Before they could even refresh their displays, people were liquidated. Exchanges lacked speed, orders stalled, and Coinbase futures went into maintenance in the midst of all of this. How handy, huh? The market is destroyed while traders are locked out and looking at blank displays. Do you truly believe that to be random? I've witnessed many flash crashes. However, this felt different. It was a surgical procedure. It was not a panic sale. It was a case of execution. And it took place precisely between 5 and 6 p.m. window just prior to Bitcoin, Ethereum, Solana, and, of course, futures closing. XRP, of course. Consider that. They trapped traders, liquidated overly leveraged positions, and let the institutions to refill their bags at half price by crushing XRP just before the closing. Retail was destroyed. Wall Street received a break. Take a peek at the headlines while all of this insanity played out. In addition to the current tariffs with China, President Trump announced a new one that will be 100%. The press goes crazy. Crypto conveniently becomes the blame while stocks plummet and commodities fluctuate. The smoke screen is the ideal cover for a well-planned cleanup effort. They use the news cycle as a weapon to defend the destruction of markets. And what do institutions do when retail panics? They enter silently. S1 modifications begin to take effect within hours. Bitwise, Franklin Templeton 21 shares, Wisdom Tree, and Grayscale all update their spot XRP ETF registrations in the same cycle. Do you believe that to be a coincidence? Not a chance. That's a tactic. That's placement. The suits play that way. Retailers make emotional purchases. Emotion is manufactured on Wall Street. Retail responds to collisions. They are produced by Wall Street. It's not something you put together overnight. And in the midst of all of that, Canary Capital registers a new ticker for their XRP ETF, XRPC. Months of coordination are required. Meetings, filings, and timing all go according to plan while the price is destroyed. This wasn't devastation. It was reset. In order to start again from scratch, the suits cleanse the system. Additionally, it is visible in real time. Most folks overlook that portion. Loss isn't the point of these crashes. They have to do with placement. The actual game is behind the chart, not on it. While everyone else is staring at red candles, the ETF infrastructure, liquidity settings, and filings are being finished. A run does not finish here. It's getting ready for one. And listen, you already know how this works if you've been around long enough. The outcome of every time XRP has been pounded in this way is not collapse. It's a new beginning. The next leg starts when the leverage is restored and the weak hands are flushed. The quiet before the storm is here, the storm that might change XRP's future course. Let's go on to the portion that everyone ignores, the cause of this collision, because everything becomes clear when you realize who stands to gain. The sell-off wasn't organic. Liquidity was surgically extracted. The sort of thing that only institutions can do. They planned it, not merely responded to price. As you can see, XRP fell from $310 to $125. That wasn't panic in the store. It was a cascade of targeted liquidation. Algorithmic triggers, massive short-term volume spikes, and frantic liquidation bots were all precisely timed to occur just before the Coinbase futures closed. They depleted, cleared the slate, crushed open interest, and used the leverage. Why? That they may repurchase at a lower cost, and see what transpired immediately after the smoke dissipated. The XRPC ticker is locked in by Canary Capital. Grayscale and Franklin Templeton subtly modify their XRP allocations. Bitwise makes changes to their S1 documents. It is not advisable to schedule several ETF modifications during a significant market meltdown unless you are preparing for a significant event. It takes weeks to prepare these documents. Attorneys, auditors, liquidity providers, all of whom operate in the background. Here's what's actually happening. They are preparing the groundwork for institutional admission. However, they must eliminate volatility before that can occur. They require inexpensive tokens. They need to get rid of the emotional, overly leveraged retail traders. And this crash achieved precisely that. Capital moved from retail hands to institutional balance sheets with each liquidation. Stop loss hit, and exchange maintenance notification. Private ledger to the public market. Although it's harsh, it's the reality. Rallies are not chased by Wall Street. Bottoms are engineered by them. They stifle emotion, incite the most terror, and then subtly build up. Now consider the timing once more. Following the dump, S1 modifications began to arrive. Custodian partnerships were filed, and ticker names were locked. This is the period of silence prior to ignition. While the price remains suppressed, they are completing the paperwork. That isn't. Coincidence? And the system is readjusting its settings. This is the point at which you must pay attention. Because institutions are laying the groundwork for the next chapter while everyone is fixated on red candles. XRP's transition from a speculative coin to a regulated utility-driven liquidity mechanism is the latter. Those files become active as soon as the SEC starts approving ETFs again after the closure. You'll see why they dominate the market when that occurs. This was a positioning event, I tell you. I created something that every serious XRP investor needs because of this. The template for XRP millionaires. This isn't hype. The institutional setup, the ETF schedule, the documentation demonstrating coordination, the actual operation of this system, and a graphic roadmap of the upcoming liquidity phase are all thoroughly explained. The video breakdown and comprehensive guide are linked in the pinned comment. It will enable you to see what's actually happening on the charts while everyone else is in a panic. Let's return to the significance of all of this now. This accident was preparation rather than destruction. And if you know where to look, you can already see the symptoms of that. The narrative changes from panic to accuracy at this point. Because there wasn't anarchy after that planned collision. It was rebuilding. After the wipeout, pay special attention to the charts. As if drawn by a magnetic pull, XRP returned to the 2x22x30 area within an hour of reaching that vicious 1x25 low. That volatility isn't random. That's accumulation of deep pockets, huh? Well, this type of. Retail customers with a few $1,000s in leverage don't cause a V-shaped recovery. It results from trading desks and institutional algorithms grabbing discounted liquidity. They move precisely and are aware of when the order books thin out and when the stop losses congregate. Prior to the rebuild, this was the reset. It is actually visible in the on-chain data. All of the main exchanges had billions of dollars in open interest before the liquidations. That cleared the slate. The market has been blocked for months by all of that excess leverage. And what occurs following a complete leverage flush? The market levels out. Open interest recovers. However, it's genuine this time and wasn't exaggerated by overexposed retail traders. Take note of how the ETF modifications followed this wipeout right away. The crucial indication is that the lawsuits are not backing down when they submit changes during a period of instability. They are realigning. It's a calculated cost basis reset, higher future, lower entry margins. They are aware that in order to anchor those funds when the ETFs go live, they will require strong liquidity and steady pricing. They so initiate a correction, eliminate the noise, and reload at levels that are consistent with long-term logic. Grayscale is making changes to its filings for this reason. For this reason, in the midst of the carnage, Franklin Templeton and Canary Capital are obtaining